Hello everybody, welcome back to another valuation investing video, and today in this video I'm going to be getting into Celsius stock because they just had their earnings report this morning and the stock is absolutely tanking throughout the day. It keeps going down. This is one of the worst days for Celsius stock, so we're going to be getting into this company, taking a deep dive into this earnings report, why it's actually tanking. Then I'll be getting into my intrinsic value calculator to see if we should be buying on this huge dip. So let's get into Celsius. But before I get into the video, please hit the subscribe button. Let's get to 5,000 subscribers by the end of the year, please. It costs you nothing and it will help you learn more in the future, so please just click that button. Let's get into Celsius. As I said with Celsius stock here, as we can see, the stock is down almost 30% on the day today after that earnings report. The stock is absolutely tanking after this report. The stock was up a ton over the past year. It had a huge rally from when it was down a lot. It has been rallying like crazy, but after today, it is definitely gave back some gains, but still up a bunch. But down nearly 30% on the day, not good for the stock. As we can see here with this Q3 earnings, first, let me just tell you what Celsius is if you don't know. It's basically just an energy drink company for now. They make they just make drinks basically. So that's what they are. But if we get into the earnings report, as we can see here, they reported revenue of 725 million compared to estimates of 716 million. So they did beat on analyst expectations for the revenue this quarter. But looking at how much year over year growth, 173% year-over-year growth from Celsius is insane. This company is growing insanely fast, and me personally, I see a bunch of people buying Celsius, and I think a lot of younger people are into Celsius. I think the energy drink, a lot of people are maybe addicted to it with caffeine, and I think a lot of people do enjoy Celsius, and they are willing to buy a bunch. Also, with the EPS adjusted, 42 cents per share, beating 28 cents. So this was 50% above estimates. However, the net income was negative, so there was actually a reason for this. I'll tell you why a little bit later, why the net income gap was actually a miss. A swing from a net income of 6.4 million. So technically they lost money if we use these accounting rules. So just keep that in mind. Also, the operating margins were down. Adjusted EBITDA did beat also and was up 4,573% year over year. So overall, this looks pretty good for Celsius. But if we go over to Celsius, the key takeaways of this earnings was strong revenue growth. Celsius saw massive revenue growth, primarily driven by North American business, up 184%, also including the momentum from Alana new brand, which they did acquire. Also, the earnings beat with their adjusted EPS, that was good. However, taking a look at the profitability concerns, despite the strong top line growth, the reported GAAP net loss and the significant drop in the operating margin suggests that operating expenses have grown faster than sales, raising concerns among some investors. Strategic growth also, the company cited strengthening its long-term partnership with PepsiCo and uniting Celsius, Alana Nu, and Rockstar Energy under one total energy portfolio. So that is looking good for their strategy upcoming. I like that about this company. If we get into this actual net income statement here, I did some ratings here. Revenue looks insanely good, 173% growth. Like I said, very good growth. Also, the North America was very good with 184% growth. However, the international is not looking great. Only 24% growth in the international segment. That is not good to me. Obviously, if this was some other company that wasn't growing as fast, this would be very good, 24%. But for this company, I'm giving this a red here. This doesn't look great for that. Gross margin increasing very well. Net income, however, went negative. So you might be wondering why I didn't put a red here. I honestly think it's not that big of a concern just because of some accounting issues. As we can see, the single biggest charge was distributor termination cost. Celsius recently acquired the Alana Nu brand, and in the process of moving its distribution network over to the much larger PepsiCo distribution system, this must legally terminate their agreements with Alana Nu's previous independent distributors. So that's technically why the net income was negative. So in reality, they actually had some pretty good EPS here. So that is why I gave this a B. I think this earnings report was still pretty solid. The net income statement was still pretty solid. But if we take a look at the short-term guidance here, this is probably the biggest problem we have with Celsius, which in the management team, particularly the CFO, characterized the upcoming fourth quarter as noisy and cautioned investors about significant short-term cost pressures. Margin pressure from integration. The largest headwind comes from the integration of the recently acquired brand that they got into the massive PepsiCo distribution system. So this company recorded $246.7 million in termination costs, which is why the GAAP net loss was $61 million. Also, operating expenses, sales and marketing expenses are forecasted to remain high, expected to represent 23 to 25% of sales in Q4. So that is where it's at. The biggest problem with this company is the margin pressure in operating expenses going forward, but that is because of distributor termination. So it does, if we don't look at the GAAP EPS, this looks very good, but if we do look at the GAAP net loss, it's obviously not good. And we still have some good long-term outlook though with Celsius. Margin normalization, management still projects that margin pressures will begin to normalize in the first quarter of 2026. Also, continued revenue growth with the building of a total energy portfolio with Rockstar Energy, Celsius, and Alana Nu to capture a much larger energy drink and international expansion. International revenue is a key growth vector, showing strong year-over-year growth of 24% as they leverage their brands into Canada, the UK. So I think if they could actually start to grow this, which I'm actually bullish, I think they can start to grow this even faster. This will be insane for Celsius in the future. So with that being said, let's go over to market-io and take a look at the SWOT analysis. Taking a look at the SWOT analysis for Celsius here, looking at this, we have strengths of proprietary product differentiation. So they maintain a competitive edge. It's clinically backed Meta Plus blend, which combines metabolism boosting ingredients like ginger extract and green tea. So they do have a slight competitive edge there. They also have strategic distribution centers with PepsiCo with their partnership. That looks very good. And acquisition driven growth with their acquisition of Alana Nu. This will continue to help them build their portfolio and just overall continue to grow fast. Now, the weaknesses, however, intense market competition with the energy drink sector. A lot of people are making energy drinks. That is something to be worried about. Also, geographic revenue concentration, 92% comes from the US with only 2% international exposure. That I think is the main problem here. And also the dependency on PepsiCo. I don't think that's too big of a worry, but if it does fail, then that would be terrible for this company. But I don't think that's going to fail. PepsiCo's a huge company. I think this is actually good for Celsius to streamline their production. So with that being said, going over to my investing platform, valuationinvesting.money, if I go over to the stock analysis here and we put in Celsius stock, let's put in Celsius and take a look at this company. Scrolling down here, taking a look at Celsius, market cap of $11.1 billion. PE ratio, however, insanely high at 113. So this is trading at a very elevated premium. It does make sense though. They're growing at over 100% revenue growth in the past year over year. So it does make sense. Free cash flow yield also pretty low. That's not great. You want to see this higher, 1.31%. So the metrics for the valuation do look pretty bad in terms of that. But compared to their growth rates, I don't think it's that bad. They're growing insanely fast. It's just, do you think they can continue to grow in the future this fast? Also, the balance doesn't look great. The net cash is a slight concern. I don't like how they actually have more debt than cash, but it's still not too big of a concern because most companies do have more debt than cash. If we go over to the 7-step stock analysis though, we only get 3 out of the 7 key metrics here. Forward PE ratio is pretty elevated at 43. Return on invested capital looks good. Revenue growth looks good. However, the EPS growth, due to that recent EPS, due to that accounting error, that's why it's negative though. So I wouldn't be too worried about that. It's still growing well. Shares outstanding are increasing. We want to see them buying back, so that's not good. Debt to free cash flow also is a little bit elevated. So overall, the fundamentals don't look great with my criteria, but I do like the growth rate of this company. So with that being said, let's do a bear case growth rate 10%. Base case, I'm going to do 20. Bullish case, I'm going to do 30% in the next 5 years. I think they can continue to grow near 20 to 30%. Now for the future profit margin, right now their profit margin's at 8%, but let's say they increase this to about, let's do 8, 10, and then 12%. I think they can continue to increase their profit margins as a result of the distributions with PepsiCo. Also, the future P ratio growing at 10%, you deserve about a 20. Let's just do a 20 P ratio. Base case, I'm gonna do 35. Bullish case, I'm gonna do a 50 P ratio. Now for the shares outstanding, they're increasing at about 2 to 3% each year. So let's just do 3, 2, and 1% increase. So if we calculate the intrinsic values here, we get about a 5% return base case. So me personally, I'm actually kind of interested in this company. I don't like how they don't have a huge competitive edge over other companies though. But honestly, if this company were to grow 25%, this would look pretty decent from today's price. If you think they can grow over 25%, I think Celsius looks pretty interesting. I would like to see this get to about $35 if I were to buy. I'm still just worried about the competitive advantage. They don't really have a great competitive advantage, but I do know a lot of people do like Celsius. A lot of people buy it. A lot of people go out and try and get it. Just from personal experience, I've seen a lot of people try and buy this drink. So a lot of people are addicted to it. So that could be a positive. But right now, I'm personally not buying, but it's getting close to a buy price, I personally believe. So thank you guys for watching this video on Celsius earnings. Please subscribe, hit the like button. If you want to go check out this website that I made, click right here, go to the Patreon. You get a 7-day free trial to try out this website. Thank you guys and see you.